Welcome back to Politico Finance Summit. My name is Johanna Thygesen, and I'm here to chair the next panel discussion, during which we will address the key question of whether Europe needs a fiscal overhaul. With us online rather, to discuss are Jörg Kukies, State Secretary in the German Chancellery and a close advisor of German Chancellor Olaf Scholz, Carlos Cuerpo, the Secretary General of the Spanish Treasury, Peter Praet, the former executive board member and chief economist of the European Central Bank. And joining us later will be Niels Thygesen, the chair of Europe's Fiscal Board. A very warm welcome to all of you. Before we start, I would like to remind our audience that you can ask questions using the Swapcard app. If you would like to tweet about this session, please use the hashtag PoliticoFS. Now, thanks to the great reporting of my colleague Bjarke Smith-Meyer, we learned yesterday that the Commission has no intention of enforcing the rules of the Stability and Growth Pact, even when it's back in place next year. And I'm wondering what that says about a post-crisis regime if we're going to start off with the rules that we are ready to ignore. So perhaps, Carlos, might it have been better to just officially keep rules on ice?
Yes, thanks. First, thanks for the invitation. It's a great pleasure for me to be in this very distinguished panel. So let me give, let's say, a few pointers on your question on the need somehow to reintroduce rules, have new rules, overhaul the rules. So basically, what we know so far is that the unprecedented response that we had to the crisis, with a massive public support to households, firms, to actually be able to support their income, was partly possible thanks to the activation of the general escape clause and the shift towards a more qualitative surveillance in the EU. What we need now is somehow to make sure that the rules in place once these exceptional circumstances are lifted are fit for purpose in this new context. As we see now, there's a strong recovery in the euro area, and the challenge, of course, will be to make sure that it is not a short-run bounce back, but it is a transformative process. In the short term, of course, we know that uncertainty remains very high, particularly to the pandemic and also to the impact of rising energy prices. And in this context, fiscal policy should be able to, or at least try to minimize the long-lasting effects of the pandemic by somehow encompassing the phasing in of economic activity with a gradual phasing out of support measures, making sure that the transition to the recovery mode is as smooth as possible. Let's say from a more structural perspective, we know there was somehow consensus before the crisis about the need to revise the rules, simplify them, and also to be able to build a more sustainable, more digital, and more inclusive growth path going forward. And the pandemic has only accelerated those trends, making it really imperative to act now. And these will require, from the part of all member states, very unprecedented levels of public as well as private investment. And we know that from the Commission calibration or estimates that these investment gap in the upcoming decade can be in the range of up to 650 billion per year. So we need to prevent investment going forward from becoming once again the first victim of consolidation strategies. In this context, I would say that the relaunch of the economic governance review is very timely. There's strong consensus that we need rules to ensure proper governance in the euro area, and we cannot afford somehow those mistakes of the past strongly in the recovery. So, of course, we know that the discussions will intensify in the coming months with a view to hopefully reach a broad-based consensus. And in that sense, Spain will try and contribute with a very proactive and constructive approach going forward.
Carlos, I think my question was more, though, how do you feel about the way this is being transitioned? Does that make sense to officially reintroduce the old rules, but say we're not going to stick to them? Maybe Jörg, you could share your views. What do you feel about this approach? Would it not be better to then just keep rules on ice? officially? Unfortunately, we cannot.
Sorry, you asked Jörg, or did you ask me?
Yes, you. Please go ahead.
Okay, yes. I mean, somehow the timing is of essence. So we need, and that's what I was trying to say, once the exceptional circumstances are lifted, we need rules that are fit for purpose. Therefore, let's say going back under normal circumstances to a setup that we all thought, even before the new challenges, that somehow had a strong need for a revamping, would somehow be a step backward. So we need, let's say, a renewed framework in time once we get outside of the general escape clause.
Jörg, do you hear us? Because I think we didn't hear you just now.
No, I think is it good?
Yes, fantastic. Thank you.
Okay, perfect. So I think, of course, it's completely legitimate to have this debate, and our coalition agreement also foresees an active participation of Germany in this debate. But I think there can't be any discussion about the applicability of the rules if and when we leave the general escape clause. And as I learned, because some of my colleagues were listening in on the previous panels, Commissioner Gentiloni was very clear on that by saying that the general escape clause will likely end next year, and that means that we will have reliable and enforceable rules. So in that sense, I think it's very clear that as long as we don't have new rules, we stick to the old rules, and those will also be applied. So I think that's what we owe to ourselves. Otherwise, of course, any discussion about new rules will be implied in a negative way. So I think we have to keep those two areas and those two sets of discussions apart. As to the discussion around reforming and overhauling the SGP, we have a very clear view that the past almost 2 years were clear evidence that we already have a very large amount of flexibility in the Stability and Growth Pact. 2 months after the crisis broke out, the finance ministers were able to agree on a 540 billion package of loans through the ESM, the EIB, and the SURE program. A few months late, 2 more months later, the Next Generation EU program was set up. In the interim between February and July, Germany set up its bazooka reaction of fiscal policy to the crisis. France implemented very far-reaching, expansive fiscal policy, the same in Italy and Spain. So nobody can say that we lack flexibility in our fiscal framework. I do think it's very legitimate and correct to have a discussion around how we will confront this need for very substantial investment that we're facing in the green transition and the digital transition. Of course, given the latency with which Next Generation EU will be paid out, a very, very large part of the answer is, of course, Next Generation EU, because a large amount of the 750 billion package will be deployed in the next and coming years. So in that sense, it's not like we have a deficiency of fiscal capacity in the next few years, but it is a legitimate question on what we do in our frameworks. But I wouldn't limit that framework to the SGP only. I think we have to think very carefully about what we need to do to crowd in more private investment. If I see, for example, how much of offshore wind in the North Sea is being financed completely by a private sector, there's a huge interest and a huge ability of the private sector to fund this. My Danish colleague just told me yesterday that in their recent auction of offshore wind capacity, instead of paying subsidies, the Danish government is actually receiving money from the providers of wind parks as a sort of concessionary payment for the permission to set up wind farms. So I think those are areas that we have to consider carefully. And we have to make sure that our IPCEI framework, the Renewable Energy Directive, all of the packages around the Fit for 55 are set up in a way to facilitate private sector investment and to crowd in that private sector investment. For example, we've committed to cutting in half the planning permission times. I think that's one of the areas where, in addition to, of course, thinking about SGP, we also have a few areas of reforms that can still be done in our countries to allow this investment to take place.
Before discussing those perhaps in further detail, I would like to come back with sort of the initial question to Peter with a financial market perspective. How important do you think that if the Stability and Growth Pact becomes effective, that we do adhere to its rules? Do you think not doing so could backfire on financial markets?
Thank you, Johanna. I think it's urgent to clarify, the fiscal framework, because as you know, the ECB has started a sort of normalization process, and trust in the sustainability of public finances will be key in the smoothness or not of the normalization process. And we have seen, last week how sensitive markets are. We have seen again tensions on spreads. And excessive expectations, I think, on a backstop that would be provided by the central bank via its quantitative easing program. And so I think the articulation between the two, major policy issues, how do you normalize monetary policy, and how do you articulate that with the clarification of the fiscal rules? I think it's absolutely fundamental. And what is fundamental is trust, you see, in the sustainability of public finances. I looked, just preparing a little bit for this meeting. I was still amazed, that in 2008, if you look at debt GDP ratios in France and Germany, they were broadly similar, around 60% of GDP. If you look today, you're about, around 70% in Germany, 120% in France. It's a huge difference. And this sort of debt dynamic is very worrisome. And so I think it's absolutely urgent now to clarify where we are going. And that we will discuss a little bit later. I just wanted to say that the question about interest rates, I know that debt service ratio have fallen very much, even in high debt ratio countries. But as markets show, if they lose trust in sustainability, then they would rely largely on the central bank buying additional assets, public debt. And I think that sort of vicious circle, I would say, has to be broken by very credible rules and rules that are implemented, actually. That's for the later discussion.
You're in a bit of a hot seat here, of course, because we're all really waiting to hear the German government's position on these reforms. And I know you said they can't be all, but it is a key issue. And I was wondering whether you could shed some light on, you said Germany is open to a discussion. Are they open to reforming the rules of the Stability and Growth Pact? And if so, which elements do you think are absolutely necessary to protect? And where do you actually see room for improvement?
Well, I mean, to paraphrase the coalition agreement, I would say we have sort of a three-step approach. Step one is to say what I said at the beginning, namely, we already have a very large amount of flexibility. So given the amount of public investment that has taken place in the last 2 years and that will take place through Next Generation EU in the next 3 years, it's not like in the immediate future we have a lack of ability to implement public investment. And even in those countries, and I'll take Germany as an example, that don't benefit substantially from Next Generation EU, we are finding ways to implement the investment that is necessary, for example, with the goal of getting 80% renewable energy in our country by 2030. So, it is a key question, I think, to address that the flexibility is already very high. The second question is, of course, that we are open to debating whether we find areas of more flexibility. For example, our coalition contract sees a willingness to think about how we can make the calculation of output gaps more reactive to structural reforms. I saw, for example, last week that the Spanish Parliament passed a labor market reform, I think by exactly one vote, that will substantially reduce all of the temporary employment and transfer them into permanent employment. My view is, if therefore through a reform like that, the Spanish labor market becomes more resilient, that should translate in through the channel of the output gap calculation into a higher productive capability much more quickly than is the case already. So that is a specific area that is explicitly mentioned, for example, in our coalition contract as a way to make this system more responsive and to reward those countries, or to give a benefit to those countries who are going through reforms like that and who are consciously increasing the productive potential of their economies through economic reforms. And the last point that I would like to make, and that is exactly a point that Peter pointed out, our coalition contract also foresees a very strong focus on long-term debt sustainability. And I think that's an issue that we have to think very, very hard about. If we see that more and more central banks are normalizing, that has an impact, of course, primarily on the regions where the central banks are normalizing, but of course it will have an impact on capital flows in Europe as well if the Fed does what the dot plots predicted will do. And we're already seeing yields in the US going towards 2%, and of course that will have an impact on global capital flows, and we have to factor that into our thinking in Europe as well if we think about debt sustainability and enforcement of fiscal rules as well. And that's also a point that we foresee very clearly as something that we have to pay attention to as we think about revising or overhauling the SGP framework.
But what about this argument of credibility? I mean, there seems to be a pretty wide consensus that it's, given the high debt levels, it's just not realistic that, we could reduce debt so quickly. So as Peter pointed out earlier, credibility is also something that's extremely important for financial markets. So could you see Germany agreeing on changing these sort of parameters and how to adjust and reduce debt over time?
Well, I mean, as I said, there's an openness to addressing issues, but again, I don't think we need a very substantial and fundamental throwing overboard of the fiscal rules that we have. As I said, we've seen in the recent past that the framework does offer ability and flexibility around the debt levels. Of course, this problem has gotten more severe or more pressing because the debt levels have increased, but we certainly don't foresee a very fundamental overhaul of the rules. And again, I think what I read about Commissioner Gentiloni's remarks earlier in a previous panel, I think we have very clear agreements that the fiscal rules have to be implemented again if and when the general escape clause is lifted. So in that sense, I think we're completely open to discussing flexibility around the rules and reforms and how we can further incentivize investments and structural reforms. But I don't think we need a fundamental questioning of the structure of the Stability and Growth Pact.
There have been two key proposals that would allow Europe to push ahead with the green transformation at a time of strict fiscal rules and high debt levels. And one is the golden rule that would omit green investments from any deficit cap. And the alternative is a massive increase in the EU budget as of 2028, with designated funds that would allow member states to tap to tap those funds by presenting spending plans that Brussels can then police. Between these two option colors, is there one that you would prefer?
Yeah, thanks. First, let me just recall on what Jörg just said, and where I think there is quite an agreement on the fact that we have to be pragmatic and really find, and I think there are many vectors, good basis for consensus. So at this stage, I think having, let's say, realistic and credible, because that leads actually to better enforcement going forward, that would be the key. Also, as Peter said, in order to provide some certainty around the framework, not only for next year, but also for the medium term. And here, of course, acknowledging the flexibility of the system under exceptional circumstances, we need somehow a system that is fit for the new reality and for the new challenges going ahead. On your specific questions on how to incorporate those investment needs for the twin transition, the green or digital transition, I think here it's getting a bit more into the details of the specific proposals, and as you said, there are different ideas on how to improve the framework in order to avoid this underinvestment in these two areas. And I don't think we are at a stage of really somehow preempting the debate on a more detailed level, but somehow pointing to the different options that you just mentioned. We know that the golden rule could somehow grant special treatment, as you said, to some categories of expenditures, and it has merits in the sense of its legal implications. Somehow it would not require changes to the secondary legislation, not to the treaties, so that could be a positive side of it. But on the other hand, we know that we would have to agree on the specific definitions of green, digital categories, as well as effective ways to somehow avoid creative accounting on these lines. And also other caveats could be why not actually enlarge these exceptions for other expenditure items such as education, which is also a very efficient way to increase the denominator effect and increase long-term potential growth. So I think all these elements have to be taken into account because then there are other options on the table. So for example, there is another one which is also aligned with the argument that Jörg said in terms of including investment and reform agendas within the medium-term planning. So basically in a similar way, with a similar function that we've had for the RRF, for the resilience and recovery funds, basically taking those lessons into account. So this option would really benefit from increased ownership and reinforced adaptability to country-specific needs, basically gearing the different fiscal paths or consolidation paths, taking into account this extra degree of flexibility given the reform effort or the investment on specific areas such as the green one. And then there are, of course, let's say within the discussion, additional considerations. For example, the idea that there can be some EU public goods considerations in the discussion. So somehow there are some projects, some ambitions that can be of an EU pan-EU dimension, and somehow also have very large spillovers between member states. And the economic nature of those specific investments could somehow justify also some partial financing from EU resources and not leave them entirely to the domestic fiscal space. So to some extent, all of these are on the table, all these options, and equally valid at this stage. And it is, let's say now, the work to be able to distill and get to a specific solution while agreeing on the main vector and on the main principle, which is the need to somehow get these public and private investment needs, as Jörg said, into our future decade.
Thank you very much. Niels, I would like to get you in here because the Fiscal Board has done a lot of work on this as well, I understand. So could you tell us whether you think that one or the other option seems to have more advantages? We can't hear you.
The European Fiscal Board has indeed looked at these two options. We had initially a preference for extending the scope for allowing investment inside the fiscal rules without consequences for the Stability and Growth Pact. But in our latest report, we also discuss the option that was mentioned by Carlos, having a European fund, European finance activity, which would permit closer monitoring. The essential question in deciding between these two options is which gives a better combination between national ownership on the one hand and close monitoring that the investments done are really in accordance with European priorities, provision of European public goods, of which the green transition, of course, is to deliver the most important part. So that may swing the argument a bit, in our view, towards the idea of having a European initiative, having an enlarged European budget, have something to replace the RF after 2026. But I outlined by saying it that way that there is some time to discuss how this could best be done, because we do have the RF for a few more years, and the support for the economy is very substantial if you look at exemptions for investment, for example, because, for example, in the Spanish case, I believe that the stimulus to the economy from the investments under the RF, if fully used, will be in the order of nearly 2% a year over the next couple of years. So that suggests that there's less of a need immediately for looking or deciding on this issue. So I'm glad you brought this in, but this is really the second dimension of the economic governance, the true title of the discussion we are having here. Stability and Growth Pact is one part of it. That is the more technical, detailed part, which also needs a revision and which could take place or should take place earlier, because we need that from 2023. Whereas the other element, the how to treat investment in the future and whether to establish a central fiscal capacity on a modest scale, but still a new initiative, whether that could wait a few more years, possibly for the midterm review of the current 7-year budget. Thank you.
But I mean, introducing the budget often would potentially reduce the need for adjusting the Stability and Growth Pact to the same extent, right? So is that not a discussion that needs to be had at the same time?
Yes, it could start now, but it doesn't need to be implemented already from 2023. That's not necessary. Absolutely. But certainly the principle should be clarified, because it does have implications for how you manage the rules. I'm glad the word sustainability was mentioned, because we are, of course, still in a situation where I think 6 countries have public debt ratios of above 115%. So that's clearly too high. But in order to have respect for the kind of more technical revision of the rules, you must revise them first. They have become too lax, and they've been too flexible and too administered in a way that too much discretionary management on the part of the Commission and the member states. So I think we need to look at that question more urgently than the longer-term issues.
Right. So is that then fair to say that for you, in the discussion on reforming the Stability and Growth Pact, you think it's the priority should be on how to ensure that new rules will be implemented?
Yes, I think, as has already been mentioned by several speakers today, more emphasis on expenditure growth, which is a way of formulating the policy indicator that the public can understand and appreciate more than the structural deficit, which is hard to observe, despite the scope for improving it, as Jörg mentioned. I think we need to get to a more manageable, observable, simpler system, and also one that is not excessively intrusive by year, setting year-by-year standards, which require too much information relative to what we actually know.
Jörg, what's your view on this idea of having a significantly enlarged EU budget down the line to help finance green investment, especially if we see that Next Generation EU turns out to be a success? Is that something that you think, even if it does not have to be decided now, is something that you could feasibly agree to?
Well, I mean, first of all, we have the multi-annual financial framework agreed until 2027. So as you say, this is not really the right point in time to already have debates around what will happen in 28. I would say that, of course, in 27, there will be a discussion around whether or not the size of the budget is appropriate or not. But I think the even more pressing question, and I think that will get more and more pressing as we move in the direction of 2027, is are the focus items and are the priorities of the EU budget right? And as long as agriculture is still the largest position in the EU budget, and a form of agriculture is still subsidized that I would say still needs overhauling in the direction of climate neutrality, to put it mildly. I think we should first talk about quality of the budget before talking about quantity of the budget. You also asked about green golden rules earlier, and I would like to answer that. Also to add a little bit of spice to the discussion. Even if it goes against my good friend Carlos, I am very skeptical about these green golden rules because we've just seen a clear evidence recently when we had the discussion around taxonomy that the attempt to objectify and to go through scientific neutrality to define what is green and what is not is just not possible. And we've seen when we had our own golden rule in Germany that once you open Pandora's box to exempting specific forms of expenditures from fiscal rules, you really open Pandora's box. And alone in the ECOFIN discussion, the last one that I was privileged to take part in, ministers used as applications of the green golden rule, things like education. Carlos just mentioned that. One minister even said we shouldn't talk about the green golden rule, but the sustainable golden rule. Defense expenditures lead to the sustainability of the security of our system. Hence, we should also exempt defense from the counting towards deficits, et cetera, et cetera. So I just think it's impossible to agree on privileging certain expenditures over others, which is why also through our own experience, what we witnessed for a very long time in Germany, once you have these golden rules, you'll always find reasons to exempt a huge number of expenditures. So I think we're very skeptical on that point.
Right. Would you like to respond to that? Just want to give you a chance, Carlos. You've made your point.
Yes,
maybe,
yes, I appreciate actually. I was going to say that's actually what I thought I had said. That there are lots of issues when it comes to the implementation of those rules. And therefore, even though there can be some advantages in terms of its legal application, then when it comes to the practical implementation, we know that somehow it is not the easiest, and we have to find, or there is need to find other solutions. And that's why I went to these solutions, again, agreeing with Jörg, which I think should be the conclusion of this, that basically a good way would be to be able to incorporate those into the definition of, let's say, our medium-term paths, to join the RRF, the resilience plans, and the SGP at some point in terms of providing enough flexibility for both objectives to be aligned.
Jörg, do you want to get back to that? I think we've clarified the
No, it's fine.
Right? Okay.
Agreeing to agree is always easier than agreeing to disagree.
I want to ask you, Peter, now. The German finance minister, Christian Lindner, said that it is important that there should be strict deficit rules in Europe to help the ECB to contain inflation. What do you think fiscal rules must look like to take the pressure off the ECB?
I think all what we discussed before. I said that there is too much, expectations, I think, in the markets that the central bank will intervene to control, unwarranted, development on capital markets. I think governments, and the framework should help, the central bank not being pushed by markets, in that sort of situation. And that's why the debate on fiscal rules is so and the governance of fiscal rules is so important. But markets, they like to have, growth-friendly consolidation. So it's not, what we used to call, austerity. So it makes sense to look a little bit at the quality, to look a lot on the quality of public finances. And that's how the debate on the golden rule has come in. But as Jörg was saying, I had in mind, social golden rules, defense, etc. There are huge demands, in the coming years about public goods. And how is this going to be financed? I think Niels came, some of these public goods, are European, some are more national. I think there's a big debate on public goods now. But at the end of the day, for public finance sustainability, you need growth, and so you need to look at, the way you spend the money, actually. And we are already in a very high tax sort of environment in Europe. And so you have to look at these issues and try to be careful. I'm very much in favor of expenditure rules. I think that most people would agree on that. But then you start with exceptions, as Jörg was saying. I think on green, for example, it makes sense, to have it off budget, to have, and he gave a number of examples about private-public sector, cooperation. I think it's more the role of development banks, and that can be leveraged much more than today. So I think you need simple rules, and the more you go into, refining, what is golden, what is not golden, semi-golden, the more you make it less credible. And the more then, of course, you have the risk, that markets would say, well, at the end of the day, the central bank will be there as a backstop. And I think this is very dangerous in general, but in the present context in particular.
So this is sort of like, what are you asking from finance ministers? But then what is the ECB doing on the other hand? I think it's kind of interesting that they recently decided that they're willing to deviate from the capital key in their asset purchase programs, even now that we are outside what they call like the emergency phase of the pandemic. What does that ECB policy do for fiscal discipline, though?
But you see when you watch, the press conference the other day and the speeches, this is really kept in what we call the constructive ambiguity, because the market doesn't want to create, the central bank doesn't want to create moral hazard, but there is moral hazard today. And so when you say you're going to use flexibility for example, to counter non-fundamental volatility of spreads, and that you have the tools, the instruments to do that, but then you stop saying, I'm not going to tell you what I'm going to do and in what circumstances, that creates uncertainty in the market. Let's look at the other side of the coin, is to say, basically, why are markets nervous? And why do they want to have a backstop from the central bank? Because they don't trust, the fiscal rules and the sustainability issue. So you need to act on both. I'm not saying the ECB should be totally absent. Absolutely not. They have to be, involved in the transmission mechanism across countries. I think that's a fair, objective. But on the other hand, you need to be balanced counterweigh that very credible fiscal rules. And for the time being, that's my main concern. The speed at which you go now in clarifying the rules doesn't fit very much with the other side of the coin, which is a normalization process that might, I'm not saying it's going, but might be much faster than what many people expect. And then you get a discrepancy between the two.
Mm. So how has this unexpected resurgence or comeback of inflation changed the discussion about the fiscal framework, especially in the near term, in your respective workplaces? Maybe, Jörg, would you like to start with that one?
Well, first of all, of course, inflation is a core objective of monetary policy, and therefore, of course, inflation, targeting the inflation rate and making sure it stays within the definition that is foreseen in the treaty is the clear prerogative of the central bank. So I will not comment on what that means for the ECB. That is for good reasons, in the complete independence of the ECB. Of course, we see a fiscal read across, especially from the element of inflation that is energy prices, because of course it is highly socially regressive, which is why we have a complete understanding and completely support the Commission with its toolkit that it published, with which we can respond with fiscal means to mitigating the impact, for example, of increased energy prices. And I understand that in many member states there were actions taken. In Germany, for example, we are paying a 135 euro direct transfer for those who receive housing aid. So in that sense, I think it's possible for us to use reaction functions, A, through automatic stabilizers, B, through these one-off fiscal instruments to address inflation. So in that sense, I think that's the division of labor that is foreseen and that I think is good. And I would limit myself to those comments.
Okay, thank you very much. Carlos, perhaps a quick response from you. Has the return of inflation gotten you more worried about having to adjust more quickly than anticipated?
But there, I mean, to some extent, I would also echo what Jörg just said on the fact that we are price takers in terms of getting the ECB policy and the normalization of its extraordinary measures. But basically, we would all be expecting that at some point this gradual normalization would start, and particularly since mid last year, when inflation was actually beating expectations and forecasts, let's say on a repeated basis monthly. So in that sense, for us, when it comes to the let's say the fiscal strategy, I think that there are two main dimensions. So one is that we got from the Treasury point of view, let's say, already our homework done in terms of benefiting from the very good conditions of the market over the past couple of years and even before, to actually reduce the interest cost and then the average interest of our portfolio, and at the same time somehow lengthen our average maturity in order to lock in those interest rates for longer. So that would be, let's say, one point that would ensure in the next future, over the course of the next few years, still some downward inertia in our interest rates spending over the medium term. And then on top of that, I think coming back to the RRF and the importance of the recovery plans. So at this stage, we're able to witness something that is not in the textbooks, which is basically have at the same time an expansionary fiscal policy on the back of next-gen money and on good quality spending, which is investment spending, targeting our potential GDP, and at the same time consolidation in the main ratios. Debt to GDP ratio is foreseen to be reduced already this year, and deficit ratios are foreseen to quickly converge to the 3% over the medium term as well. So I think this would be also important issues at stake here.
All right, thank you very much. Unfortunately, we have run out of time now. So thank you very much to our discussants. We've agreed to disagree and agreed to agree, I think, especially on the need to clarify rules as quickly as possible. So thank you very much. We now have a break here. The next session will start at 3:50. My colleague Bjarke will interview the Irish Finance Minister and Eurogroup President Pascal Donoghue. So please join us then. For the audience here, we now have time for some networking. Thank you very much.